Let's talk about covered calls, which is what we're looking at today. So, covered calls, and even in this type of market environment, I actually think is really beneficial. Whenever we are discussing cash secured puts or covered calls or on the income side, when we're selling options, volatility is good for inflated premiums, but especially in stocks that we believe in long term, enhancing longer term portfolios, even sideways markets, covered call writing can be really, really helpful because it allows you to participate in capital appreciation, but we cap our upside. So there's a lot of benefits of this strategy if you've never looked at it before. So loving the market timing around it. If you don't know me, Jessica Inskip, Director of Education and Product here at OptionsPlay. My job is to make sure that education and application go together. It's great that we learn and understand these concepts, but we also want to apply them. And that is inclusive of market mechanics, which is really important when we're dealing with the complexities of options. So, nonetheless, here we go. And also, if you've never attended an Options Play education session, it's important to let you know what we stand for. We stand for empowering you to trade sustainably and confidently. If you understand how something works, you feel supported and you can make better decisions. And that's really the intent here, is to make those confident decisions, especially when we get in markets like we are today, volatile. It's a roller coaster ride. We're up 400 points one day, down 400 the next. But that's a sideways market. That's a wash right there. Before we dive in, there are some real examples today. We'll probably pull up the Options Play tool as well. Know that options involve risk. They're not for everyone, but if you're here, you're taking in that investment in your education. There's going to be some securities and tools. They are purely for informational and educational purposes only. I am not responsible for the daily play or macro view here at Options Play, which means any example that we bring in didn't go through that process that it goes through when we have those stock picks and things like that. So just know that it hasn't gone through that process. Therefore, all right. So let's talk about what we'll focus on today. Whenever I talk about covered calls, really that's the step into options trading. And there is a little joke we used to have when I worked at different brokerage firms. And if you hear a squeaky toy, I apologize. My dog is making her presence known. The You tend to start trading options with either long calls and long puts, but you always end up selling at some point. And it's your stepping stone where you're speculating. You realize that that requires a lot more management and sharp directional moves. But when you get into the sell side of options, probabilities tend to be more in your favor. And so it's that move into options. So I like to start with an anatomy of an option because it brings the puzzle together, but it also is a beginner strategy, but something that we can enhance and bring ourselves together on, which means we have to talk about options pricing very, very briefly. We'll talk about growth versus income because that's the type of securities that we'll be looking at in options, a derivative. We derive it off of the underlying security. We add that layer of complexity when we have an expiration date, and that's what we have to account for. Again, if my dog is bothering you, I'm going to go steal that the squeaky toy from her, so I apologize. Then we'll talk about constructing the covered call. So what does that look like on your overall portfolio, and strategy management, which is extremely important. So when we're talking about choosing ideas for an option, sometimes we focus on getting the best idea to go with our investment thesis and enhancing our longer term portfolio, but we also have to talk about our exit strategy. So make sure we cover that and of course save some time for Q&A. But what I want you to focus on today is how can I generate a consistent and additional yield on a portfolio utilizing options? So quick review, what is an option? An option is a contract between a buyer and a seller. The buyer is paying the premium. They can execute on the terms of that contract. They're in the driver's seat. They are the ones in this example. It represents 100 shares of ABC at $100 per share. They can say, I want to go ahead and buy that if it was issued as a call. They're in the driver's seat. The seller, they're writing the contract. That's why it's called an options writer. They receive that premium, an upfront payment, in exchange for an obligation to fulfill those terms. So if the buyer has the right to buy 100 shares of ABC at $100 per share at any time, the seller, someone's got to sell it to them. The seller is the one selling it to them. And that can happen at any time because they're the passenger. So a lot of times I get asked, how do I know I'm going to be assigned early? When is that going to happen? Well, it's just like if you are the passenger in a car. How do you know you're going to stop at a stop sign? You pay attention to your surroundings. You see that there's a stop sign ahead of you. Otherwise, you don't know. So that's what the focus is of going through the basics. Is it helps you understand exercise and subsequently assignment, because the person who's exercising is the person who owns the execution rights, which is the buyer. They paid for that. You, as the seller, received a premium, and your intent is not for them to have those execution rights. And then it's issued as a call or a put, which just tells if it has the right to buy or the right to sell. So a buyer, speculative. They want the contract to be worth as much as possible. So in this case, the higher ABC goes, the better the contract, or the higher value the contract obtains. Whereas the seller, that's working against them. They don't want it to have any value. They want it to stay honest. It depends on strike selection. And that's what's really important to focus on as we move forward. So anatomy of an option. It's a contract. If it sounds like legal jargon, that's because it's a legal contract. It's what quantity are we agreeing on? One contract generally represents 100 shares. The product, that's the underlying security. It's a derivative derived from the stock. Can also be an index or an exchange traded product, can be a commodity. There's so many products that options can be utilized for. The price, also known as the strike price, always price per share. Time frame, I'm using June 30th in this example. That's the expiration period because that's that layer of complexity we're adding. You have an expiration date. That means this contract's going to cease to exist at some point. And that's something that requires management because now we have a ticking clock on it, which is just that it's not going to trade at some point. Issued as a call means the right to buy. Put means it contains the right to sell. The contract can be exercised. Again, you may not intend to do that, and oftentimes that doesn't happen, but that means the buyer executes upon the terms that the contract contains, can expire as soon as that expiration date passes by. That contract is no longer tradable, it's not valid, but prior to that, it can be traded on the market for a price known as the premium. And so this is where, if you've attended my previous sessions and we focus on options pricing, we always look at it with positive and negative factors because that helps us with strategy selection. But before you can know the positive and negative factors that affect your option, you have to know how a premium is comprised. This is a foundational element. So two components, intrinsic value and extrinsic value. Intrinsic value really means, does it have executable value? The terminology for that is it in the money? So that same example, we have an ABC 100 strike contract call and ABC's at 110. Well, that has to be worth at least $10 because the call contains the right to buy at $100. If I can immediately sell it at the market at 110, that's $10 worth of value. It's in the money, which means it won't necessarily be in the money. That it could not. It could be at the money or out of the money. Extrinsic value is made up of two components. So 3 of a premium, 2 intrinsic and extrinsic. So time value just means the more time it has until expiration, the more expensive it's going to be. And that's logical. If I have the right to buy ABC at 100, that's going to be more expensive for me if it's 30 days till expiration than if it's something that expires tomorrow because it has more time to gain intrinsic value or gain executable value. It's all based on the driver, which is the buyer of the contracts. And then the third component of a premium, second of extrinsic value, is implied volatility. We're in earnings season right now, and it is the best example of it. And remember, it's all about, when is this option, or does this option have a chance of gaining executable or intrinsic value? And implied volatility, the definition of it is the market's forecast of a likely movement in the underlying security. I know that is very technical jargon there, but a large variance in movement occurs when there's high volatility because volatility means uncertainty, and there's more uncertainty around earnings, and there's an end date to it. So we know that a stock is going to report. Today we had Google reporting, and prior to Google reporting, if you pulled the options today, they had an inflated implied volatility. and they had an inflated premium because there's an expected move in either direction. We don't know which direction until they report, but because there is an expected move and there's a more highly likelihood of it gaining executable value, it inflates the extrinsic value component of the options premium. And so that's what I mean by the positive and negative factors and looking at everything from the driver's and the passenger's side. So the person who is buying the option, movement in executable value is great. We want that movement. But time value as the option starts to expire, that is going to hinder the options buyer, but it's going to help the options seller because we're selling it at a higher price. We want to be able to buy it back at a lower price. So time is going to work in our favor. And implied volatility, if it's high and we expect it to come down, that's good for an options seller, but that is not good for an options buyer, which is what makes earnings season really challenging. Taking speculative views the day of earnings, unless it's something like Nvidia or a high beta stock, even then it still has an inflated implied volatility. So it takes proper structure to amplify and mitigate the positive and negative factors. So I know we spent a lot of time on that, but it's important to know, especially when we're talking about covered calls. But intrinsic value, the way I like to remember it, is internal factors that affect the options price, which is executable value, and extrinsic value is external factors that affect the options price. We know intrinsic value is the underlying security moving up and down. External is time and news-driven events, macroeconomic data, all of these things that can make the likelihood of a movement higher or lower are really out of the contract's control. So we need to add the layers to this. Where did they go? If you've never seen this chart we use to start at the beginning of Options 101 and build it out all the way to the Greeks. I like to call it our most stolen slide at OptionsPlay, which is fine. Just credit us, share it. Absolutely. But designed this to really help you wrap your head around how options work. We're focusing on short calls today, but in order to understand short calls, you have to know long calls. So long options are the driver, short calls are the passenger. Always think of it that way. This T chart is actually something I was personally exposed to when I was taking my Series 7 many years ago, over a decade ago. That ages me a little bit. But we have calls on the left-hand side and puts on the right-hand side. The intent of this is if you know long calls inside and out, everything else is essentially a mirror. And without going into detail, because this is not an Options 101 webinar today or video today, we are focusing on the short call aspect. There are some components of this that you still need to know for today's session. So first and foremost, purchased options, you have the right to buy or sell. They're purchased for a premium and you're looking for sharp movements. Short options, which is the focus today, specifically short calls, sold for a premium and contain an obligation, but they're not looking for a sharp movement. You just need the stock to stay exactly where it is, or you have a slight directional bias and time decay is on your side. And what you'll notice is bearish strategies will be found at the bottom, bullish are going to be at the top. And anything bearish contains a sell transaction, bullish a buy transaction. So once you lay this out in these terms and in this order, it actually makes it make a lot of sense. But today, again, we're focusing on short calls. We'll talk about long calls a little bit because this is the driver. They're the driver in the terms of execution rights, and the short call is obligated to sell. So the intent is if I own a security, and this is short call individually as a bearish strategy, we're going to flip our deltas around, which is a term that you don't need to know. So don't worry about it. All right. So now let's talk about our longer term portfolios. Normally, when we're investing in stocks for the first time or wherever you are in your investment journey, there are two separate categories that we focus on: growth versus income. Growth stocks, those are your technology stocks. They tend to have a high PE ratio. They generally don't pay dividends. Sometimes they do, but they take their company profits and they reinvest it back into the company in hopes of capital appreciation. And normally that's innovation. You need stocks like Nvidia or Microsoft or Google to take their profits and give us some better AI at this point, but that requires capital. But the thought is those companies are going to grow more. Whereas if you're on the income side of stock investing, the first one that comes to mind in my mind is AT&T, because that's just one of the most notorious high dividend flyer securities, things like 6 or 7%, they have a lower PE ratio because not as much growth is expected, but they pay a dividend. But that means when they're taking any, and there's this theory out there, $1 of dividends paid is $1 not reinvested back into the company. However, are you looking to grow your wealth or are you looking to protect it? Is how we look at this from a stock perspective. So growth versus income. The idea of the covered call is we can combine those things together. So you might have a security that you've purchased and you've had for a very long time. So do know if you sell it, it is going to create a taxable event depending on the type of portfolio that it's housed in. But a covered call, we're going to use the obligation found within the short option to create a sell price, kind of like a limit order. So the intent is we're going to add yield to our existing portfolio. We're going to use options. It's going to be a covered call, creating a obligation to sell very much like you would if you created a limit order. You create a limit order within your brokerage firm's account, your shares become collateral and you sell it once that bid is hit if you whichever terms you specify. So let's talk about what that looks like. This line here represents you owning the security. When you own 100 shares of an optionable stock or ETF, the most that you can lose is the amount that you spend, the capital that you are putting forth, right? The most that you can gain is unlimited. But is that going to happen within a certain time frame? There's lots of structure that we could add to that. So the intent of a covered call is we're going to utilize those shares as collateral and receive a premium for creating that covered call, but we're going to create an obligation and cap our upwards potential. So with options, there is always a give and a take. The give in this instance is we have a capital expense of owning that 100 shares. We're reducing the amount that we spent, our cost basis, by the premium that we received. That's what this represents. That's the give. The take is instead of the unlimited gain potential, we've just capped our max gain at the strike price. But that's why strategy selection is extremely important and why it's very important to understand how an options premium is comprised in order to figure that out. Because the closer that we make this max gain capped or strike price that we choose to the underlying securities price, the higher income it's going to give us, but also the lower capital appreciation we're allowing ourselves. So that's where our tools are built to help you identify those opportunities. So I love to use this example, and it's always fun to see where securities are when you pull these screenshots from from when this was, because Apple really hasn't moved that much, but we know that. But as a stock investor, let's say we did own Apple for the duration of when we've held this, and you bought it at $168 or per share, which is the time that this screenshot was taken. And you have a price target of 180. So you've held it for this time and you say, you know what, Apple just announced an event. There is AI's coming. I know they're going to do it. They're the ones with the free cash flow. I'm holding out on it. But you're stuck in this sideways trend and you still believe in the company. But you do want to get out of it if it hits that limit price of $180 per share. So you create a limit order. And the intent of this is you say, okay, I want to participate in capital appreciation until 180. And that also matches up with the resistance that you've defined. You're willing to risk $168 per share to make $12. That's your risk versus reward. You're exposed. You could technically lose up to $168 per share. Unlikely because it's Apple. I think we'd have bigger problems if that happened, but it could happen. And your reward is $12. We're looking at risk versus reward. That's your exposure. And you can also collect dividends. And you also have voting rights. There's other things that you have as being a stock holder in this case. So the stock and options investor, what they would do, very similar, is create an obligation to sell. So since a call contains an obligation to sell, that's the type of contract that we'll choose. We're going to collect a premium. In this case, it's $1. It's not that much in comparison, but if you were to annualize that and do it constantly, that definitely adds up. So your risk exposure is reduced by $1. You still own the stock, but now we're risking 167 to make 13. So really that's $2 in the grand scheme of things. So your exposure is you're going to generate an additional $100 a month and also collect dividends on Apple until it reaches $180 a share. And you can do this weekly, you can do it 45 days, you can do it any type of duration. You can change it and you can adjust your strike price as much as you want. But it's important to understand those components when we figure that out. So let's talk about creating an optimal covered call and what you would look for. Now, this is where OptionsPlay's tools come in handy because we default these. So if you're to put an underlying security that's bullish, or you put in a stock that you already own and select that income tab, by default, it's going to give you the optimal one. But it's always good to know the methodology and how it works. So we've got Seagate technology here. And again, I do like using the older screenshots because it gives you an idea of where the stock was and the actual outcome. We get to see that. So you own Seagate Technologies. We're giving you the optimal expiration of 45 days. That was back tested off of S&P 500 securities, so that's just the giveaway here. That is a weight of, remember those positive and negative factors that I was talking about at the beginning. The something that we want to amplify is theta decay, which is just your time decay. So when an option starts losing its value as it gets nearer to expiration, which again is logical, the time works against us no matter how hard I try for it to not. That means that what especially if you've attended the Greek sessions as well, it's not a linear thing. It's gets to about 21 to 14 days and then accelerates, but then you could end up having some risk. So the optimal expiration is really based off of allowing you to experience that time decay in addition to having enough time to inflate your premium. That's the intent between the 45 days. Any adjustments, then we got to look at applied volatility and other factors, which is what our tool automatically takes into account. So then the question here is, go ahead and throw this in the chat if you'd like. Which strike would you choose? Would you choose a 100 strike price, a 97.5, or a 95? So are you going to create an obligation to sell at 100? You'll collect 75 cents. Your raw yield is 8.85, annualized 7.14. So raw just means taking this, dividing it by that, and then this is annualizing it, just to give you the math behind it. And then if you know deltas, higher the delta, closer it is to the money. So which one would you choose? Now let's see. And your depends on your target. Choose delta 30. Love that. All right. Lots of hundreds, 95. What is the expected move? I love that there is, I need more information because you're trying to go for a price target. And that I think is fun. All right. So let's say your cost of the underlying is, we're implementing this now. You owned it at 88. You bought it, and now you're looking at, I love the price targets happening. Okay. So there isn't a wrong answer because it's your personal opinion. And I love that there is price targets going into account. You want to look at implied moves and apply technical analysis in order to understand your defined target price. And I think that's beautiful. And that's looking at it at the right way, because the intent of this, usually when we give this for the first time, most people say 30 delta. Oh, sorry, hit a button. And they say that because you look at and you say, oh, I'm going to get $1.50. That's the highest premium. And that's what I want to focus on. But what you're giving up, remember, give and take, is your capital appreciation. So if you purchase something at $88 or $89, you're only allowing yourself $6 worth of capital appreciation. Whereas if you move it to 100, well, now that's an extra $500 that you allowing yourself in capital appreciation, and you're only getting your half of the premium there. So that for getting an additional $75 less the 500 of capital appreciation doesn't make sense. So I love that the answers were, I'm going to choose this based on my target, and I want to see some more information, because that's the intent here. When we're choosing our optimal sell point, it's based on those factors, but we have to account for capital appreciation. So there is no wrong answer. When at OptionsPlay, when you plop this in the tool, the default that it's going to give you and analyze is going to be based off of risk versus reward and all of those factors, but it's accounting for capital appreciation while also prioritizing yield as well. Love that everyone wants to look at the charting. That brings me so much joy. All right. So let's talk about scenarios and what happens when you have a covered call. So again, the security. If let's say it rallies, and it's so important to go through these scenarios, but if it blows through your strike price, even if we selected that 100 strike price and then all of the sudden or it was a tweet or something, who knows, and it ended up to 120, well, it depends on the expiration that we have to take into account. So one, we want some theta decay to happen. Sometimes it can go too high and then it's completely gone and you could roll it or you could close it out. Now it's going to cost you to close it out, but know that it offsets itself. Meaning, if this was a 100 strike, and I'm going to have to use easy math on my brain doing this off my head. So let's say that Seagate's at 90 and our strike price to sell was at 100 and then it went through to 120. Well, that obligation to sell contains the right to buy at 100. That has to be worth at least $20, right? You'll have to buy it to close for $20, even though we received only 75 cents. So there is a big variance. But what will happen when you close that out is it will wash, meaning you're removing the cap, you'll immediately get that unrealized gain on your shares that you own. So that will come back into the equation. There was a cost that was there, but then you'll have that you lifted the obligation and it's no longer there. So that's what's important to consider is do the math. It's just the money that's involved. Now, if you roll too early, you could lock in losses for your call because is what will happen. And you may not account for the theta decay. And that's the important part here. You have something working in your favor, and that's the theta decay. You want to make sure that you take care of it. But if it blew through your strike price, that's a profit. And if you want it to be called away and it's not going to create a crazy tax obligation, go for it. You should be happy. We're never going to call the highest highs and the highest lows, even though we try. And sometimes we can get really, really close. But at the end of the day, you set a price target and your stock hit it. That's awesome. So we don't have to overthink it. Now, if it trades sideways, again, this is the optimal scenario for covered calls. We are neutral to bullish, which means we have a slight directional bias. So when this happens, we may want to roll it out again. Again, we want to account for the theta decay or some time value decay. No harm in holding the call to expiration. However, there is increased risk because if it does all of a sudden move higher, we could have gotten out of it and moved our transactions before and maybe got a little more time premium, and we didn't do that. So that's what's important to think about there. And also remember, if you do hold it till expiration, don't forget to write another call on that Friday. But again, you could roll it out and not hold it. It's entirely up to you. But when this happens, you're constantly reducing your risk exposure. If you purchase this at 88 and you're getting a dollar and you're getting a dollar and you're getting a dollar, over time, the amount that you actually spent owning 100 shares of Seagate gets really, really low. And that's just the way that I'm using it as an example. That's not your cost basis for tax purposes unless there was a assignment attached to it for that one assignment. It's not all of them together. So that's a way that you are literally reducing your risk exposure. That's the intent of it. And really the optimal securities for these are those that are stuck in a trading range, have some clear defined sell points because we don't want something that you think is going to go super, super high and sell a covered call against it because then you're capping your upwards potential or upwards exposure. So even volatile markets like this, I think are great. Now, if the stock declines, I get this question a lot as well. One, we could roll down your covered call early. You'd buy it back at 20% of your original premium. Because if it declines, remember that means your option is also going down in value, which is good. You're going to end up on a max gain scenario of the call, but you might end up with some losses on the stock. You don't want to let these go until expiration because as an option gets further away from the money, it can get rather illiquid. That also happens when it gets deeper in the money as well. So if it does move down, let's lock in that gain and you could collect more premium. and roll it down. But if you were, as in roll your strike price to a lower strike price. But the important question to ask yourself is, because this happens quite often, successful trading is a disciplined approach. So this started, and that's why I start this presentation with growth versus income. The reason why you purchased that stock, does it still remain? Is your investment thesis still valid? Is there a reason to hold this security? Otherwise, that capital that's being tied up may be better suited to be deployed elsewhere that would have the opportunity to have additional capital appreciation or get additional income. So that's the important thing to consider if you're finding yourself in a declining scenario. And I think that's why Apple is a great scenario. It's definitely was stuck in a range, but had some moments of declines. Does your investment thesis still play out? Because that's one that's been very interesting this year. Didn't participate in that huge AI rally, but maybe it will. We'll see. I think it will, just so you know. Personal opinion, not advice. All right. So now let's talk about some key statistics. This is always great. And sometimes I like to put this up as a poll just to see everyone's appetite for it. There's a reason for showing you this. First of all, 7% of options are exercised, which means you may not want to do that. And that's because of the time value component. Notice how we talked about that a lot today. If someone exercises an option, normally they're giving up time value. And that's not a good idea. So there has to be a reason behind it, right? 23% of options expire worthless. And that may be your goal. Having a covered call expire worthless means that you have maximum profit. You've achieved maximum profit. I wish I could have confetti come across the screen at this moment. But that means we want strategic strike selection up to that, allow capital appreciation up to a point. And if it goes any further, call it your danger zone. And then 70% of options are traded out of the market because we can buy to close those just like we sold it to open. And if you bought it to open, you can also sell it to close. So always good to know these. All right. And let's talk about the assignment process. This is one of those slides where I spent way too long making little graphics, but I think it helps drive the point home because the most frequently asked question that we have on this session is, how do I know my option is going to be assigned early? Or why do I not know until the next day? Well, this is why. So remember back to that driver and passenger scenario. The long option holder is the driver. They own the execution terms. They are the ones that could say, I want to go ahead and buy 100 shares of ABC at the strike price, please. And you, as the seller, are obligated to sell them to them. And if you own the stock and are expecting a dividend or waiting on some other event, and that could catch you by surprise, here's the process. The long option holder would have to tell their broker that they'd like to exercise those contracts. That usually is a phone call. Some of them have it online, but they've got to contact their broker. Their broker then sends a notice to the Options Clearing Corp, aka the OCC. The OCC randomly assigns a broker that has an offsetting short option, excuse me, and that broker could be the same one or it can be a completely different one. That could have been at Fidelity and now we're at E-Trade. We don't know. It's random. And then that broker that's chosen then assigns that options writer, assigned broker. And that could be first in, first out, or random. They have to have it on file with the OCC, and they can't change that intraday without refiling random facts. But the point is, this person and this person, only this person knows the strategy of this guy, only knows that that's a covered call. This guy does not. Has no idea if that's just an individual naked option or it's a butterfly. They have no idea. And for some reason, there's this common misconception because these aren't taught, really in too many places that, oh, well, I have this strategy. No, they don't know that. They have no clue. Your broker knows that. That's it. So that's why you don't know until the next day. And this is an overnight process. Even though it's 2024, perhaps we will speed this up at some point, but it takes time to figure out who will be assigned. And it's not necessarily at the same brokerage firm. But you would know if you are likely to be assigned if you pay attention to your surroundings and what the driver is going to do. Because remember, they're not going to exercise unless it makes sense monetarily. And I've got a few examples for that, which are important for you to know as a covered call writer. So this is a Always difficult to find these screenshots, but this is Altria taken the day before an ex dividend on the first quarter. So very important for that. Meaning this dividend is paid out quarterly and it's 90 cents. Yes, this one is an older screenshot. Again, they serve purposes. The day before the X date, if you are someone who is a dividend investor, you know that that's the day that you have to own that stock in order to qualify for the dividend. So if you own it on March 23rd, then whatever that pay date is, you'll be on record and you'll receive that dividend, which means you have a likelihood of your call being called away from you if you have a covered call. So you might own 100 shares of Altria Group, but also have a covered call. And the worst thing that happens, and people get aggravated about this, is you think you have it, and then come the X date, you find out your shares were called away because the trade date would be on the 23rd because of the way that the assignment process happens. So here is how we would do the math and think about the long call holder and what the driver would do in this scenario. They may exercise to qualify for the dividend. Logically, we've had debates that it doesn't make sense, but they do it. And that's why we have to discuss this. Altria is at 53.26. This right here represents the executable or in the money value of each options contract. What I would look at is say, okay, well, if I've got a short call at any of these, if I were to exercise it, this is my executable value. If that amount plus the dividend is higher than what I can execute it on it get traded on the secondary market, you have a very high probability of getting your shares called away early, and it will probably will happen. And this is why it happens to you. So, for example, let's take the 50 strike. The 50 strike is $3.26 in the money. It's 320 by 335, so 326 in the money. Add that to 90 cents that you'd qualify. Well, this is not $4, so this will absolutely get called away early and your shares will be gone because that's a higher dividend. So that is what I mean by paying attention to your surroundings. I could say, okay, well, this clearly I'm not going to get that dividend, and you may want that dividend. And the only way to avoid that is you get rid of your obligation. You just buy to close those contracts. That's the only way to avoid assignment is to not have the contract. All right. And then I do see a question that I'm going to answer there that says, what role does extrinsic value have in the odds of being called away? So normally, yes, there's so many good things here. Normally, if you exercise, you do lose extrinsic value. So there is some extrinsic value in this one, and there's some extrinsic value in these, but you also gain the dividend in this case. So the question is, for the maximum amount that I can get for closing this contract plus the dividend. Because if I exercise the call, the long call holder, I'll own the shares. And as long as I own the shares on March 23rd, as in I close on March 23rd with owning those shares, then I qualify for the dividend. So this one here has an intrinsic value of 26 cents, extrinsic value of about what, 4, even a little more. There's extrinsic value here. But and these two, all of these are totally at risk. It would make more sense for me to exercise this and own it at 53 and then collect 90 cents of a dividend. See what I mean there? Yes, you're giving up extrinsic value, but you're gaining way more. So that's why they get called away. Why isn't the options price set by buyers and sellers? So we've done the math and it is, and it adjusts because what happens on a dividend is the stock price adjusts the next day. And this is something that my really good friend at the OIC, Ed Modla, and I have talked about many of times. The thing is people do it. And that's why I have to, I'm not even why I have to, why I'm going to tell you about this is because this is what happened and this is why. Nonetheless. So, surprise assignment. This is also another one that is really important for you to be aware of as someone who is trading covered calls or even short calls. And yes, this is an older screenshot of Tesla, but it's because this was a real scenario that occurred. So, especially as volatile as Tesla is. So, the OCC accepts exercise instructions until 5:30 p.m. Eastern Time. When do options stop trading? 4 p.m. Eastern Time. So that means this 1 hour and 30 minutes of time where it could still be exercised, but it could not be closed on the market. So now let's think about Tesla for a moment. Let's say you hold a, at this time, pre split 1060 call. Well, if Mr. Musk or someone tweeted something, who knows, and or let's say it closed. So at 12:31, it closed at 10:56.78. You'd say, you know what? It's out of the money. We're good. I'm going to call it a day. It's Friday. I'm going to go have my glass of wine. Everything is fine. But there was a tweet that happened, and all of a sudden, now it's at 1100 or 1200 before the OCC cutoff time of 5:30 p.m. Well, again, let's look at the driver's seat. If they the only way a long call holder in this scenario could capitalize on that movement, because you say, hey, I'm okay. I didn't hit my strike price. I'm not going to be called away. They're going to say, oof, that market is jumping. Let me call my broker. I want to go ahead and own that. Well, you will be assigned and your shares will be called away. Even though the market closed, if there's something that happened after hours, there is still this time period that the OCC accepts instructions. So you have to watch until that cutoff time. Now, the probability of this is not high. It doesn't happen often. That's why I call it surprise assignment, but it's the only way the long call holder can capitalize. And I think it's important for you to know the risks that are involved with it. All right. So here is another great example of just your best practices. This is really a summation of everything we covered today. But when am I going to create a covered call? Well, you're neutral short term, bullish long term. That's because you're neutral short term because you're specifying a sell price. And we're going to change that sell price every 45 days or whatever the duration of your contract that you choose. You own 100 shares of an optionable stock. You create that obligation to sell your stock. You reduce your risk by collecting that premium, but you also cap your gains by creating that obligation to sell. Again, this is the optimal and the tool that automatically does it for you, but it's a starting point. You can compare and contrast, and that's why it's wonderful to use. So, expiration 45 days. We're looking at something out of the money to account for capital appreciation. We don't want to lower this cap price too much because that cuts into our profit area. And then an expert tip here is we have something called IV rank or IV percentile. That's going to tell you if your options price is inflated. And if your options price is inflated, that's an optimal selling opportunity. So there's your little expert tip there. So here's some examples throughout. And then closing out, take profit 75% of your premium. So that would be the buy to close at 25% of your original sell price. Take a loss if you lose the full amount, allow assignment if you want to, and then always look at that 14 till 21 days to account for the theta decay that's occurring. And then also, what I also think is very important to consider, I call it the danger zone, is if it's rallied more than the premium that you received. Meaning, in this example, we sold a for 5. We own the stock at 165, so that's 10 points. But if it went to 180, we may want to get out of that because if it keeps going higher, we're not going to participate in that capital appreciation. We're going to have to buy it back. Whereas at that $5, that's our our little danger zone, I guess is the right word for it, if you will. So best practices that are about here. And some tips for if you're just trading about options. One, start with education. I'm all about education with everything I do. If you follow me on CNBC and wherever I talk about things, you understand something, you are empowered, you can make better decisions because you understand the logic behind it. Have an exit strategy, have a sentiment. Remember, an option is a derivative. In this case, their strategy driver, the person that's running it. Remember earlier I said you flip your deltas. You flip this to a bullish strategy. And a short call individually is a bearish strategy. When you create a covered call, you have a bullish strategy, you have a neutral to bullish strategy. So it's very important to have that investment thesis and use your tools and resources and stick to a plan. Best practices that are always important. All right, so let's focus on the questions. I saw some about the OptionsPlay tool. I'm happy to bring that up as well. And there is a ton in here, so let's go through that. So Tamara says, I was under the impression that the stock that I wrote a call for can only be called away by the long option holder when it reaches the strike price, not before. No, it can be, you're obligated to sell it at any time. Now, it's not likely when it's out of the money and it hasn't reached the strike price, but it can happen. So you are obligated to sell it at any time. The only options that can only be exercised on expiration are index options, which you cannot create a cover call on. And okay, so we answered that one. Udera, if a covered call is somewhat deep in the money, and if I believe it's worth keeping the stock, and there are no risk factors like the ex dividend date or earnings, how early to the expiration should I roll a covered call that is somewhat deep in the money? Should I wait closer to expiration? Also, the bid ask spread in the stock is wide, 10 by 120. Should we consider selling covered calls? So we can sell covered calls um, on any stock that you own. Remember, it's just capping your upwards potential is important there. Now, if it's very deep in the money, this is something, if you attended my Greek session, that we'll talk about, but something happens when it blows through your strike price. If it gets so far deep, it gets to a point, regardless of expiration, where it starts acting like the stock, meaning it loses its extrinsic value. And when that happens, there is no reason to hold it, because the reason why we're waiting to roll is to capitalize on extrinsic value decaying or theta decaying, that time value decaying. Those are all synonymous words. If it gets too deep in the money, there's no point. Allow yourself to participate in that capital appreciation unless you just want it to be called away. And your likelihoods of it being assigned and called away are actually really high in that scenario, Udera. So really, really great question. All right, Pauline. So I'm an OptionsPlay member, or probably yes, excuse me, and very happy with that. And I'm learning. I have a question: which scenario is more effective, holding SPY shares and selling call options and rolling up, or trading wheel strategy according to the methodology taught in other webinars? Both options will require equal capital. It does require equal capital. So it's really, really up to you. Again, all self-directed, but the difference here between the covered call and the cash secured put is upwards momentum. When you have a cash secured put and you're trading something like SPY and it's range bound, you would want to sell the cash secured put to own the security if you haven't already, maybe when it's at the top end, meaning if you expect it to come down, you could be setting yourself up for a better scenario, and I feel like I explained that very poorly. When you sell a cash secured put, the maximum that you receive is the maximum gain is the premium that you receive, which means if it's going to go any higher than the premium that you receive, you would have been better off buying the stock. So it's a sweet spot of the premium that you received next to its resistance point. And if that's where I look at selling my cash secured put when I'm looking to wheel into something, is where's the next resistance zone? Where is the premium up to that point? Because if it rallies to that, I'm very confident, I have high conviction that it will come down. So if it does, my max reward is going to be equivalent if I was owning the stock. Whereas if it were to go down, I wouldn't expect that yet because of rally. That's what I mean, if that makes sense. That would be so much better with a visualization of some sort, but you're taking into account the premium that you receive in addition to your next stopping point for something like SPY. I think something like SPY is great to do the wheel strategy on, especially it's any security that is in a range bound market for sure. Not saying that SPY is right now, but it is. If I bought the stock for a much higher price than today's price, is a covered call a good idea to get income on top of the dividend? Plus, provided that losing the stock results in a big loss. So that is a wonderful question, Tamar. A covered call is a great idea to get income off of it and reduce your capital expense. Know there's a tax event that's going to occur here too, which is a separate scenario, right? That you may want to take into account. But this is that question of that we get asked all too often. It's going down. Do you still want to hold that stock? And is that capital better spent elsewhere? is how I would answer that. But yeah, if you believe that it's going to come back, like those who've held Apple for a long time, perhaps selling a covered call, allowing for capital appreciation is going exactly when you see those resistance zone is going to allow you to reduce your risk exposure in addition to receiving those dividends. Because eventually, slowly over time, that's going to bring down your cost. Uh, right. What do I do if I want to keep the stock, but it's just blown past the strike price? Is it worthwhile taking a big loss? So remember, you're going to take a big loss on your call, but that's going to be offset by the gain that you're going to get back on your stock. Take that into account because there's a limited risk on this. It's not a naked call. Because you're which has an unlimited risk potential, it's covered. You have a predefined buy price. So there it's just the math behind that. So if you sold the call again at 100 and lived the stock extreme example is at 150 and you have to buy it back for at least $50, but your stock is going to get an unrealized gain of $50. Do you see what I mean? So it's going to offset itself. You're going to claim a loss and create that taxable transaction on your short call, but your long option or your long stock is going to have an unrealized gain. So again, tax wise things there, but that's important to know. Um, can you repeat the difference between index and stock options regarding assigning? Yeah, so there's lots of logic with this. You can't own an index. You can't say, I want to go buy SPX. You can go buy SPY. You can buy an ETF that mirrors an index, but you can't buy the index. So index options are cash settled. So in that same, which means they can only be exercised on the day of expiration. And they're because there's no physical delivery of an index. You're not going to sell an index in your account. You're not going to buy an index in your account. That's different with the ETF, SPY. That's considered an equity option. But with the index, you would receive the difference of cash. So if it blew through your strike, you'd be debited that amount. If it went below it, you would be credited it. That's the difference. Yes, there will be a recording available as long as you're signed up on a free trial or a member. Uh, I see someone's answering it. Thank you. What about writing calls at the money simply for income when the stock is near support area, rents and repeat? Well, you are creating a that's what I love doing the Greeks. I'm trying my best not to talk too much about them. You are not expecting too much movement at that point. You essentially are just collecting income and keeping it in one place. You are not allowing capital appreciation. So you can do that as long as you don't think that the stock is going to go anywhere. But if it's nearing a support area and finds support, that tends to be like a ball going from floor to ceiling. So that could be a risk where it found support. So there was demand that overcame supply and it sends it up. And then you didn't allow yourself for capital appreciation. So there is a danger in that. It would be if that is support, but very close to resistance in like a really stuck low beta sideways neutral position that you're creating. Barry, if you didn't see the 2 p.m. Fidelity webcast, you can go to fidelity.com/in the money, and they're actually all linked there. You can see past ones as well. It takes, I believe, about 24 hours or so before you'll see it. Did a really deep dive in GDP today. So that was a fun one. Uh, but yes, if you did not miss that. And if you guys aren't aware of that, Tony and I do a show with Fidelity every Thursday at 2 p.m. We give our macro views and 2 trade ideas, and then we also manage the trades as well. All right. So we hit time. And I think we answered most of the questions. All right. So this is the part of the month, if you will. Well, I actually would hand it over to Tony. Tony and I are gonna be at a conference next week, so there is a reminder, we're not gonna have a Thursday session. And Tony will be taking over for the month of May, and then I will be coming in for the month of June. So, surprisingly, we're already in summer. That's amazing. So, I do like to, in my last session, just give it a couple moments. If there's something that you guys want to talk about, please put it in now and I'll take it into account. I've been doing my sessions based on what you guys are saying. These sessions are for you and for our members. So let us know what you want to talk about. Before you guys said technical analysis, I have that on the backlog. So we'll definitely be doing that. But if there's any other topics, let us know. Otherwise, thank you for the kind words. Love the emojis. I hope everyone has a wonderful rest of your week. And I will see you in June.